Japan, May 2025. The government formally warned that U.S. tariff mechanisms and sanctions policy were generating systemic risk in global capital markets. Not a protest, not a diplomatic objection phrased in softened language. A risk statement, the language of a finance ministry calculating exposure. From a government holding $1.128 trillion in U.S. Treasury bonds. In the previous video, this analysis traced how $300 billion in Russian reserves frozen in February 2022 permanently altered the risk calculation for every foreign holder of dollar-denominated assets, and how China's $558 billion divestment between 2013 and 2024 established the operational template for using Treasury exposure as a calibrated policy instrument. China's case was visible, bilateral, contained within an already named confrontation. Japan's case is structurally different. Japan is not a geopolitical adversary. Japan holds more U.S. Treasury debt than China ever did at its peak. And Japan is trapped in a mechanism that it did not choose and cannot exit quickly, while Washington applies tariff pressure that makes the trap increasingly uncomfortable to remain inside. This video does not analyze whether Japan will act. It dissects the mechanism that determines what Japan can do, what it costs to stay, what it costs to leave, and, at the end, what happens inside the United States when the mechanism transmits outward pressure into 84 million household mortgage payments. The system does not require intention to produce consequences. Only the math needs to change. Japan holds $1.128 trillion in U.S. Treasuries, the largest single foreign sovereign position as of early 2025. That position was not built by a single strategic decision. It is the structural residue of 4 decades of yen-dollar trade mechanics. Japan's export sector, automotive, electronics, precision manufacturing, prices goods in dollars, collects dollar revenues from global sales, and generates annual trade surpluses of approximately $70 billion in dollar terms. Those dollars must be placed in an instrument liquid enough to access, large enough to absorb, and stable enough to hold. The U.S. Treasury market is the only market meeting all 3 conditions simultaneously. With over $26 trillion in liquid outstanding instruments, it can absorb $70 billion in annual Japanese placement without distorting the market price. No alternative exists at equivalent scale. The European sovereign bond market totals approximately $11 trillion, but lacks unified fiscal backing. Japan's own bond market cannot absorb its own surplus in dollar terms. The yen and dollar are separate currencies with separate yield curves. So the dollars return to treasuries, year after year, automatically, without a decision being made, because the alternative is a currency translation problem with no clean solution. Japan did not choose treasury dependence. The export model produced it as a compounding byproduct across 40 years. The trap closes in both directions. If Japan were to liquidate its $1.128 trillion position over 12 to 18 months, Treasury yields would rise sharply, increasing U.S. borrowing costs on new issuance by an estimated $60 to $90 billion annually. Simultaneously, the dollar would weaken against the yen as Japanese institutions converted dollar proceeds back to yen. A stronger yen raises the dollar price of Japanese exports in every foreign market. Toyotas cost more in euros, and pesos in Australian dollars. Reduced export competitiveness produces lower dollar revenues. Lower dollar revenues produce a smaller annual surplus. A smaller surplus means fewer dollars requiring treasury placement, but also a smaller economy. Japan cannot exit the position without damaging the engine that generated it. The mechanism feeds back on itself. Exit is structurally self-defeating at speed. But the constraint binds in the opposite direction with equal force. The United States cannot pressure Japan through tariffs, through sanctions signaling, through public confrontation over trade balances, beyond a threshold without triggering a reassessment inside Japan's Ministry of Finance of whether $1.128 trillion in conditional U.S. holdings remains an acceptable institutional position. In May 2025, that reassessment produced a formal public warning. The warning did not name a number. It did not name a timeline. It named a category, systemic risk, from a holder of $1.128 trillion. Naming systemic risk in the same market where those $1.128 trillion are held is not a diplomatic statement. It is a description of a decision under consideration. The lock point is not a military base or a treaty clause. It is the 10-year yield auction held every 6 weeks, at which Japan's Ministry of Finance decides, without announcement, whether to submit full bids, reduced bids, or to let maturing bonds roll off without replacement. There is a third channel through which foreign creditor decisions transmit consequences, one that requires no government-to-government confrontation, no formal policy change, and no action by the U.S. government at all. It runs directly from the auction clearing rate into the monthly payment on a mortgage in Ohio. As of 2024, total U.S. household debt stood at $18 trillion. Mortgage debt accounts for $12.4 trillion of that figure, the dominant component. Approximately 65% of outstanding U.S. mortgages carry fixed rates benchmarked at origination to the 30-year Treasury yield. An additional 25% are adjustable rate instruments that reprice periodically against current Treasury yields. When the 30-year Treasury yield rises by 1 percentage point, the monthly payment on a newly originated $400,000 mortgage increases by approximately $230. Across 84 million owner-occupied households carrying active mortgage debt, a sustained 1-point yield increase removes approximately $110 to $130 billion annually from household disposable income. Not through a tax bill, not through a policy decision anyone voted on. Through the mechanical relationship between an auction clearing rate set in Washington and a payment amount calculated in a bank's loan servicing system. The transmission extends further. Student loan balances outstanding, $1.77 trillion. U.S. corporate debt, $13.7 trillion, a significant portion variable rate or maturing within 5 years, requiring refinancing at prevailing rates. Credit card balances held by 160 million Americans, averaging 21.6% interest in 2024, already the highest rate recorded in 4 decades. A 2 percentage point increase in the Treasury yield baseline, achievable if 3 or 4 of the top 6 foreign holders reduced auction participation by 15 to 20% simultaneously, would push credit card rates above 23% and add an estimated $350 to $450 billion annually to aggregate U.S. debt service costs across public and private borrowers combined. No formal declaration required from Tokyo or Beijing. No coordinated meeting, no stated intention, only smaller bids at the next 6 consecutive quarterly auctions, each one individually explainable as a routine portfolio management adjustment. In 1997, Thailand, the baht fell 54% against the dollar in 6 months after foreign investors reduced exposure to Thai government securities. GDP contracted 10.5% in 1998. The IMF's $17.2 billion rescue package required 30% cuts to public spending within 18 months. In 2010, Greece, the 10-year yield climbed from 4.5% to 12.5% over 18 months as foreign institutional holders reduced positions. The €110 billion EU IMF package required public sector wage cuts of 20% and pension reductions averaging 15%. In 2018, Turkey, the lira lost 43% against the dollar in a single calendar year. Consumer price inflation reached 25.2% by December. Central bank net foreign exchange reserves fell from $92 billion to $47 billion in 12 months, as the government depleted reserves defending a currency no longer trusted by foreign holders. 3 countries, 3 continents, one mechanism repeated. Foreign-held sovereign debt exceeding a critical concentration threshold. Creditor sentiment shifts, not by conspiracy, but by independent institutional risk reassessment running through the same models at the same time. Yields rise. Domestic costs follow. The government carrying the debt pays a cost that was never itemized in the original borrowing contract. The United States carries $36 trillion. 25% foreign held, 31% maturing within 12 months. The mechanism is not different. Only the scale and the fact that a US Treasury disruption would propagate through every financial institution on Earth that holds treasuries as collateral separates this from its precedents. The auction yield mechanism. The yen-dollar recycling trap that locks Japan into holding and Washington into restraint simultaneously. The household debt transmission channel that converts foreign portfolio decisions into mortgage payments. The collateral conditionality revealed in February 2022 and absorbed into every central bank risk model since. For structures, one logic: whoever holds the maturing bond sets the terms of the next issuance. So the question is not why sovereign debtors become structurally exposed to their creditors. The question is who holds the 6-week auction clock in Tokyo, who controls the reinvestment desk at the People's Bank of China, and who processes the bid submissions that determine the rate at which $11 trillion in treasuries get refinanced in the next 12 months alone. The system does not require coordination to function as a constraint. It requires only that each major holder, operating independently, reaches the same portfolio risk conclusion from the same observable data and submits a slightly smaller bid. A 15% reduction in reinvestment by the top 5 foreign holders removes approximately $630 billion from annual treasury demand. That $630 billion must be replaced by domestic buyers at a yield high enough to clear the supply. No meeting required, no communique, no stated intention beyond institutional risk management. The inertia sustaining the current equilibrium is not loyalty, and it is not political alignment. It is the absence of a substitute instrument at equivalent scale. China's renminbi represents 2.8% of global foreign exchange reserves against the dollar's 58%. The infrastructure that would allow an alternative to function: unified bond issuance, deep secondary markets, full capital account convertibility, rule of law for foreign holders enforceable without the cooperation of the issuing government, does not exist in any alternative system. Building it takes decades. That absence is the mechanism's deepest lock. Nations remain inside the Treasury system not because they trust it unconditionally, but because the cost of leaving, in yield spreads, in currency volatility, in lost reserve asset liquidity, still exceeds the cost of staying. Even when staying means absorbing tariff pressure. Even when staying means holding assets that a February 2022 style order could freeze. Even when staying means that the audit of conditional trust has already begun. Quietly, in every central bank risk committee that ran the calculation in the week after the Russian reserves were frozen. That is structural coercion. It requires no legislation. And when a mechanism of that scale is running, awareness of it is not a defense. It is only a description. None of this required a conspiracy. Only debt, issued once, never fully repaid, and held by the same nations now being told the terms of the relationship have changed. The global lens.